All right, guys. Thank you for joining us today for our SignatureFD investment webcast, Cutting Through the Noise. I'm Tony Welch, Chief Investment Officer here at SignatureFD. So for those of you that are calling in for the first time, quick snippet here about who we are. We're established in 1997 and are headquartered in Atlanta, Georgia, with an additional office in Charlotte. We're a 100% independently owned registered investment advisor with over $6 billion in assets, and not listed on this slide, but we're incredibly proud of our highly credentialed staff of over 100 employees that are here to really help our clients to obtain their goals. Now, our framework, as a quick overview, is such that we focus on 4 pillars of success in helping our clients to obtain their own personal net worthwhile. We aim to grow and protect capital today so that our clients can live and give in the future. So with that, here's what's on our agenda for today. We're going to be talking about 3 playbooks for the year, depending on various economic conditions. Now, the first is a 2023 recession scenario that would be somewhat mild in scope. Next, we're going to talk about what a recession that actually breaks more to the severe side, more of a severe recession camp, what that might look like, and what would make that possible. And finally, we're going to talk about what if you don't get a recession at all in 2023. So what a continuation of this economic expansion could look like. So let's start with that first scenario. There's pretty strong evidence that the economy is heading toward a recession in the near future. So this chart here comes to us from Ned Davis Research. The blue line in the top clip is the economy itself. And the orange line is a model that includes 27 different indicators to determine the state of the economy. So it's very robust. And we can see that their model is consistent with an economy that should be in mild recession right now, actually. Now, we did just get economic data for the 4th quarter. The economy looks to have expanded about 2.9%. But, some of these leading indicators are showing some weakness. And now the main factors in their model that are driving this economic kind of soft spot is poor consumer sentiment, weakening housing market, higher interest rates, and the bear market itself that we saw in stocks in 2022. But note here that I'm very careful to use the word that we should be in a recession, not that we are in a recession. And that's because I don't think we actually are in a recession yet. And again, 4th quarter, we weren't, and I don't think we are yet as we stand in January 2023. And why not? Well, the job market is still too strong to confidently conclude that economic output will contract. So here we're showing the number of job openings per every unemployed person that may want a job. And currently, we have about 1.7 job openings for every single person that may want a job. Now, we have seen some pretty high-profile layoffs here of late, but what we're seeing with those is those workers are being absorbed back into the workforce pretty much immediately. So we still have this tight labor market, and with labor markets this tight, it's difficult to conclude that we're in a recession today. But say this begins to break. So if this were to begin to break and the unemployment rate were to start to climb, that would be consistent with recessionary conditions. So here we're showing kind of why we have this belief that if we were to get a recession here, that it would be mild in scope. And one of the reasons for that is there's really little in the way right now of cyclical excess in the system. So this chart here shows 4 different cyclical corners of the economy. Now look at something like housing investment here in the upper left. Before the financial crisis, housing was very clearly overbuilt, and it was very overinvested. And that's just simply not the case today. We probably have too little supply and investment in housing. Now, in the upper right, we show business investment. Before the recession in the early 80s and the tech bubble, investment was way overdone. So today, like housing, business investment is likely underdone relative to history. So the economy likely has a little bit of cushion here, just simply because we don't have the excesses built up that we've had in prior cycles. Now, if there is a recession and our hunch is right that it would be mild in nature, that maybe wouldn't be the worst thing in the world for stocks. It may actually be the more bullish scenario of these three scenarios that we're talking about today. Here we're showing stock market returns under different rates of unemployment. Now, unemployment today is currently under 4%, and historically, we've actually seen very weak returns when the unemployment rate's been this low. Now, how could that be? Well, we need to remember that when unemployment is very low, inflation tends to firm and move higher, and monetary policy tends to tighten. And that's precisely what happened in 2022. Now, if we were to get a mild recession that lifted unemployment to that 5 to 8% range, the historical track record suggests much better sledding for stocks with median returns between 12 and 15%. So it's somewhat counterintuitive, but it really has everything to do with the interplay between the job market, its impact on inflation, and therefore interest rates and monetary policy. So even in the 1970s, recession brought inflation down meaningfully. I mean, recession tends to stun inflation even in a high inflation regime. And if inflation were to ease and the Fed were cutting interest rates, stocks may become more attractive relative to bonds again. So here in the bottom clip of this chart, the orange bars, what we're showing is the yield on stocks minus the yield you can get on a 10-year treasury. And while it's still positive, we can see that much of that relative advantage for stocks, it's narrowed of late. So if treasury rates were to fall in that kind of mild recessionary condition, that could actually be supportive of a higher valuation for the stock market. Now, finally, we point out that there is a major difference between a mild recession and a severe recession and the impact on corporate earnings. Now, the light blue line on the bottom clip of this chart, that's showing the year-over-year change in S&P 500 earnings. When earnings growth has been between negative 20 and 5%, so negative to pretty weak, would you believe that the stock market's actually tended to see its strongest returns? Now, that's because market participants tend to look past a short bout of soft earnings. However, when earnings drop by more than 20%, the market has tended to run into trouble. So while we believe that any recession would be on the mild side this year, in fact, you may not even seem like it's in a recession if we were to go into one. We should definitely explore that potential for a more severe recessionary outcome and what that could look like. Now, a lot of folks that I chat with are concerned and tend to believe that a continuation of high inflation would coincide with a severe recession. And you would get this massive bout of so-called stagflation, where the economy is cratering, but inflation remains very high. But that's probably just the opposite of what we should be most concerned about. We need to remember that earnings are reported in nominal terms themselves. They're not inflation adjusted. So here in this table, I'm showing recession dates in the first column, the gain in earnings during that recession in the next column, and the gain in the stock market during that recession in the third column. So let's spotlight the inflationary regime here. Notice that earnings failed to drop more than 20% during any of these recessions and held up particularly well in that very inflationary 1973 to 1975 case. And that's when inflation was really a huge concern. Now, also note that the market downside here, market returns during these recessions was far from a disaster. It was even positive in 2 of those recessions. So that's kind of that's what kind of an inflationary recession looks like and the impact on corporate earnings. But let's take a look at the worst outcome, that classic kind of hard landing scenario. Now, in this table, that would be 2008. Earnings absolutely crashed and market downside was really tough. This recession was, instead of being inflationary, it was hugely deflationary because house prices plunged. So it wasn't an inflation regime, it was more of a deflation regime. So what could that look like today? Well, I mentioned that corporate investment and housing investment were soft right now. These 2 sectors are highly interest rate sensitive. And our belief is that the Fed would recognize a recession and use what Jay Powell has referenced as the tools at their disposal, and they would cut interest rates to spur these areas of the economy, specifically investment and housing. But what if they don't? It is possible that they'll see inflation as too entrenched to cut interest rates even when the economy starts to soften, and they'd be too slow to react. And that could result in further weakness in these sectors, creating this so-called deflationary environment. Now, in that scenario, a true deflation would certainly be possible. And there are some signs that we're watching here closely that are already pointing to potential for deflation. Now, the famed economist Milton Friedman said, inflation is always and everywhere a monetary phenomenon. So let's take a look at money growth. The red dashed line here in this chart is the change in the money supply. Now, it exploded higher due to the pandemic spending, but it's been rapidly receding. And in fact, the past few months on an annualized basis, money growth has actually been down here in negative territory. And that's due to the Fed's restrictive policies that we've seen so far. So there is a risk that the Fed is too tight for too long, creating a true deflation event where money growth is negative for an extended period of time. Now, it's important to note that that is not our base case, but we should always be cognizant of the risks that are out there. Now, one of the reasons we think that we're going to avoid that really bad scenario this time around is that inflation is easing quite quickly now. That brings us to kind of this third scenario, which would be no recession in 2023. Now, here in each clip of this chart, we're showing the unemployment rate in light green. In the top clip in dark green, we're showing inflation stripping out food, energy, shelter, and used cars. So these are all categories that are either volatile or have been kind of funky in this cycle. If you strip those out, you can see that inflation is running already below the Fed's target. Now, the bottom clip is showing inflation specifically for the service sector, but just pulling out the shelter component. Now, this is important because services inflation is what the Fed is kind of worried about, that the job market is too hot and that service inflation is going to run too hot and be sticky. But if you look at the last 3 months on an annualized basis, service inflation ex shelter is below the Fed's target of 2%. And this has all happened without any destruction to the jobs market. So this likely gives, this kind of softening of inflation, likely gives the Fed enough evidence to downshift the rate that they're hiking interest rates, to slow down their rate hiking cycle, and even end the rate hiking cycle relatively soon. Now, with inflation moderating, adjusted for inflation, wages have been starting to improve. Now, this is important because consumers have been losing purchasing power really for the past 2 years. But they're now set to begin getting ahead for the first time in the last 2 years. Now, understandably, losing your purchasing power, that results in some pretty bad sentiment toward the economy. The University of Michigan Consumer Sentiment Index here, it was hitting all-time lows in the summer. But notice that it's begun to bounce. Now, if sentiment keeps improving, that would give us a good signal that the economy can expand and potentially avoid contraction at all this year. Now, as for the implications on markets, here's a chart showing that same consumer sentiment index, but also showing forward 12-month market returns after it's made major lows. Now, once sentiment has hit a trough in the past, the market has averaged a 12-month gain of 25%. So very strong returns following those sentiment troughs. So if the low for consumer sentiment is in fact in, that could be a bullish condition, at least for the first half of this year. Now, the year is still young, but the pattern thus far has been tracking the no recession outcome. Here I'm showing the Ned Davis Research Cycle Composite for 2023. Prediction, it's just year could look like based on different market cycles. They combine the pattern for an average year with the pattern for an average pre-election year and the average for years that end in 3 in the 10-year cycle. Now, it's quite strong this year, mainly because stocks tend to gain in any given year, and also because no pre-election year in history has really had to go through a bear market because we've never had a recession in a pre-election year. So the way that I would interpret this cycle is this chart is a good average market year looks like is no recession. And that would be a strong first half and a somewhat softer, cooler second half of the year. Now, I'd love to say that a no recession call would be ultra bullish, but it may not be. Upside in the year's first half, the expense of returns later down the road. And that's because an economic backdrop, which is stable, means that the Fed doesn't have to cut interest rates. Rather, they're likely to take a hike and hold approach around 5%. Now, if that appears more and more likely, longer-term Treasury yields, which are priced in the 3.5% range right now, are probably too low. We would expect bond yields to start to move higher again. Now, if a rally in stocks creates a more expensive stock valuation, while at the same time bond yields are moving higher, then stocks could become unattractive relative to bonds. This chart in red compares the yield on stocks to the yield on T-bills. Now note that it's pretty neutral right now, but it could move down here to this level if we get a first half rally. Poor relative valuations have been consistent with negative to weak market returns in the past. So really to recap here, and while I'm kind of going over this recap, I forgot to mention if you have any questions, you're able to type those in the question box, and I'll see what we can get to and answer for y'all. But to recap what we went through today, we went through 3 fairly simple scenarios for the year ahead. We see a mild recession or a continued expansion is most likely, but we're cognizant of the risk that monetary policy remains too tight for too long, creating a deeper recession. Now, many of the indicators that we follow are consistent with that recessionary outcome for this year, but a lot of that economic weakness was potentially priced in 2022. In the absence of cyclical excess, we believe it would be a relatively mild and not a severe recession, resulting only in a small pickup in unemployment. But a deep deflationary event could develop later on down the road if money growth is negative for an extended period of time. Now, there also remains a path for economic expansion this year, and that hinges on a Fed pause and continued improvement in consumer confidence. Now, if I were to rank these scenarios in order, that's probably the most logical next question. Ranking these scenarios in order of probability, we see a mild recession as most likely, followed closely by a continued expansion in economic activity this year, and far less likely a deeper recession. And that would be kind of our most unlikely case for the economic trajectory in 2023. Okay, so let's stop there and see if there are any questions today. Okay, guys, well, I don't see anything in the open questions. If you do have a question, you can feel free to email me directly at tony.welch@signaturefd.com, and I'd be happy to respond to anything that you may think of. With that, I want to thank everybody for taking the time with us today, and I look forward to talking to y'all in subsequent months. Thank you.